There's an old joke in the foreign exchange markets about being able to make millions of dollars by selling dollars. It sounds like an oxymoron, but it's rooted in reality. The greenback is so dominant that those who shun it as a safe haven currency tend to do quite well for themselves. In 2019, nearly 90% of all cross-border transactions were conducted in US dollars. This means that virtually every country in the world needs a certain amount of greenbacks on hand at all times. It also gives the United States extraordinary power over almost every other entity that imports or exports anything anywhere. In effect, this means the US can make or break economies depending on how much it wants to flex that particular financial muscle. And with tensions growing between the world's only remaining superpower and much of the rest of the planet, there are increasing calls for de-dollarization, reducing the use of the dollar in international trade. Is this possible? Will other currencies take the dollar's place? And if not, why does everyone still use it? These are important questions for investors because even though the euro has been gaining on the dollar recently, the US currency could remain the dominant force in international finance for the foreseeable future. That is, after all, what the market is pricing in. The dollar's rise began back in the 1940s when the Bretton Woods Agreement pegged most currencies to gold. But the US dollar was different. It was directly linked to the price of gold, which was set at $35 per ounce. So $1 equaled 1/35 of a troy ounce of gold. And since gold doesn't inflate, neither did the US currency. This meant that the value of the dollar stayed relatively stable and people around the world had faith that any dollars they held would retain their purchasing power. However, by the early 1970s, the price of gold rose above $35 and the US government was forced to depeg the dollar from gold. From then on, the currency became what we call a fiat currency, one whose value is backed by the full faith and credit of the issuing government rather than a commodity like gold. Now, the value of the dollar is determined by supply and demand in the foreign exchange markets. For decades, the US ran a current account surplus, meaning that it exported more goods and services than it imported. This kept demand for the dollar high because those buying the nation's exports needed dollars to pay for them. However, in 1985, the tables turned and the US went into deficit. Since then, it has only emerged out of that hole twice, in 2000 and briefly in 2017. The fact that Americans import far more than they export means that there is always a lot more dollars chasing a limited amount of foreign goods than foreign currency chasing a large amount of US goods, and this should, in theory, drive down the price of the dollar relative to others. But that isn't what happens. That's because the US issues a lot more debt denominated in dollars than it issues currency. To run a deficit, the government has to borrow money. It does this by selling bonds to investors. When people buy these bonds, they receive interest payments in dollars. Now, because the dollar is the world's reserve currency, many of these buyers are foreign governments, banks, and investors who need dollars for transactions. So they hold on to the bonds and continue accumulating dollars. It's something of a self-fulfilling prophecy. The more the world needs dollars, the more the US can borrow and the more dollars it issues. But the dollar's dominance is eroding slowly, thanks largely to the recklessness of the US government. The national debt is currently north of $30 trillion. And to service that debt, the Treasury pays out more than $1 billion a day in interest. At some point, the interest payments will consume the entire federal budget. And when that happens, the US won't be able to fund its operations without borrowing even more money, and that means printing even more dollars. It's already happened once before during the Civil War. After that conflict ended, the US had enough war bonds outstanding that the Treasury paid out more in interest each year than it took in taxes. So it started defaulting on its debt. Eventually, Congress passed the Coinage Act of 1873, which demonetized silver. The US stopped making coins with silver in 1964, and today, a dollar is only 10% as valuable as it was 50 years ago. So either Congress will have to raise taxes dramatically, which it won't, or the dollar will continue to lose value. Investors looking for a store of value may eventually decide to look elsewhere. Of course, that day is still a long way off. Right now, the dollar is the dominant force in global finance. And this gives the US both a great deal of power and an incentive to maintain the system. On the power side, the dollar is used in nearly all commodity transactions, including oil, metals, and agricultural products. This means that any country trading in these commodities must first acquire dollars. They then need to hold on to those dollars until they want to purchase something from the United States. As a result, the U.S. can use its control of the financial system to punish those it disagrees with. During the Russian invasion of Ukraine, for example, the U.S. froze roughly $600 billion of Russia's foreign reserves, half of which was held in dollars. With those assets frozen, Russia couldn't use them to pay for imports or repay its debts denominated in greenbacks. This gave the U.S. leverage over Russia and other countries that wanted to support Russia. For instance, countries that continued importing Russian gas risked losing their access to the U.S. financial system, which meant they couldn't sell their bonds or access the American capital markets. This leverage is so great that the U.S. has even threatened countries that buy Iranian oil with secondary sanctions. That is, even though the dollars won't be used in the transaction, the U.S. might punish them anyway. On the incentive side, the dollar is such a ubiquitous part of the global financial system that changing it would be enormously disruptive. And that applies both to the U.S. and the rest of the world. A reserve currency gives its issuer a great deal of power. The U.S. government can issue vast amounts of debt at low rates, which makes it easier to run deficits and pay for everything from military spending to infrastructure projects. Other countries, meanwhile, don't like the idea of holding vast amounts of dollars, which means they diversify into other assets like gold. That increases the demand for those assets and drives up their prices. For example, oil is priced in dollars, which means anyone buying oil needs to first acquire a certain amount of greenbacks. This helps prop up the price of the dollar, which means the U.S. can keep borrowing and issuing more of its currency. Now, you might think that this is good for the rest of the world because when you buy oil, you simultaneously sell dollars. This means there's downward pressure on the price of the dollar, which makes it easier for countries to repay their debts denominated in greenbacks. But that's not what happens. The world doesn't hold a whole lot of dollar-denominated debt. According to the Bank of International Settlements, non-U.S. residents hold about $17 trillion of U.S. treasuries. The problem is that private investors hold more than $30 trillion worth of treasuries. Now, if foreign holders sold their treasuries, the interest payments on all that debt wouldn't have to be paid. So it would cost the U.S. less to finance its deficit. The value of the dollar would rise because there would be fewer dollars chasing the same amount of goods. It's very unlikely that this will happen anytime soon because no matter how fed up countries get with the U.S., the dollar is still the devil they know best. And while they continue building up their dollar reserves, they're also starting to use them as collateral in repurchase agreements. These are short-term loans where securities are bought with the expectation that they'll be resold soon after. Basically, the world is borrowing dollars from the U.S. and using them to buy treasuries. This allows the Fed to expand its balance sheet without having to print more money. And it lets foreign central banks diversify their holdings and earn interest. So while the dollar's dominance may eventually wane, the transition to another currency or a basket of currencies won't be smooth. And that is why the joke about being able to make millions of dollars by selling dollars still holds true. If you enjoyed this video, check out my others on why the US dollar keeps getting weaker or watch this video instead.